Silver at $80, gold at 5,018. Two wars, two fronts, one system cracking under pressure. And while every mainstream financial channel is talking about interest rates and earnings reports, curious, the smart money is quietly doing something that has happened only twice in history. They are pulling their silver early, not rolling forward, rolling backward, demanding physical metal right now, before something they know is coming. Today I am going to show you exactly what that means, why it matters, and why next week could be the most important week for precious metals in the last 2 decades. Stay with me. Every minute of this video is going to matter. Welcome to Market Decoded. Hit subscribe. Let's get into it. The world changed this week, and nobody is connecting the dots. Surprised. Let me paint you a picture. The United States is currently fighting an active war against Iran in the Middle East. It is entering its 3rd week. It was supposed to last days. It has not ended. That war is consuming military resources, missiles, aircraft, naval assets, air defense systems, at a rate that Pentagon planners did not fully account for. And because of that consumption rate, something extraordinary happened. The United States made a decision that sent shockwaves through East Asia. They quietly began pulling THAAD anti-missile defense systems out of South Korea, systems that were specifically positioned to intercept North Korean ballistic missiles, and redeploying those systems to Saudi Arabia, the UAE, and Qatar to protect American assets from Iranian drone and missile attacks. Think about what that decision reveals. It reveals that the United States is now stretched so thin militarily that it cannot simultaneously protect its Middle East assets and maintain its full defensive posture in East Asia. That is not a small admission. That is a superpower acknowledging, through action, not words, that it has reached the edge of its operational capacity. The Guardian reported on this directly. Their headline said Seoul was left rattled by the hasty redeployment. Seoul, a city of 25 million people, sitting within direct artillery range of the North Korean border. And the missile shield protecting those 25 million people was packed onto ships and sent to the Persian Gulf. The South Korean president went on national television to tell his citizens, "Do not panic. We can still defend ourselves without American air defenses." I want you to sit with that image for a moment. The leader of a major U.S. ally, on television, telling his people not to panic because America just removed their protection. That is not a statement of strength. That is a statement of vulnerability dressed up in confident language. And Kim Jong-un was watching every second of it. North Korea fires 10 missiles, and the timing is everything. Within days of that redeployment becoming public, North Korea launched 10 ballistic missiles into the Sea of Japan. 10. Japan immediately activated its National Security Crisis Response Team, the highest level of emergency protocol available. Citizens across Japan received emergency alerts on their mobile phones warning of incoming ballistic missile launches. The missiles landed just outside Japan's exclusive economic zone. Just outside. Not by accident. North Korea has the precision targeting capability to place missiles exactly where they choose. Landing them just outside the boundary is not a miss. It is a calculated message, a demonstration of reach without crossing the line that forces a military response. The translation of that message is this: we see that America pulled its defense systems from your neighborhood. We see that America is committed in the Middle East. We see the window, and we are showing you, right now, exactly how close we can get. Every missile launch is a probe, a test of American response capacity, a measurement of how much the U.S. can handle simultaneously before it has to make the choice no superpower wants to make. Which front do we prioritize? Because here's the strategic reality of a two-front situation that most financial analysts completely ignore when they are talking about gold and silver. A superpower fighting one active war is expensive. A superpower managing one active war while deterring a second nuclear-armed adversary is exponentially more expensive. Not twice as expensive, exponentially. The direct cost of the Iran war alone is estimated at $3 to $5 billion per week. Cruise missiles cost $2 million each. B-2 bomber sorties run over $100 million per mission. 3 carrier strike groups deployed simultaneously cost approximately $75 million per day, combined. If North Korea escalates and requires even a partial military response or enhanced deterrence posture, additional carrier groups, enhanced air defense, accelerated troop deployments, you are adding another $1.5 to $2.5 billion per week on top of an already extraordinary burn rate. And that money has to come from somewhere. It comes from taxes, which suppress economic activity, or it comes from borrowing, which inflates the currency, or it comes from money creation, which destroys purchasing power. Every single one of those funding mechanisms is bullish for gold. Every single one of them is bullish for silver. Every single one of them represents a tax on paper assets and a premium on hard assets. The three scenarios, and what each one means for metals. Let me walk you through the three realistic scenarios for how this North Korea situation develops, because understanding the range of outcomes is critical for positioning your portfolio. Scenario 1. Controlled provocation. North Korea continues with missile tests and aggressive posturing but does not cross into direct attack territory. This is the most probable outcome, and it is already happening. In this scenario, the missiles are diplomatic signals, not weapons of war. But even this scenario keeps the United States in a permanently elevated alert posture in East Asia, consuming resources, diverting attention, and maintaining the kind of geopolitical uncertainty that keeps institutional money flowing towards safe haven assets. Gold does not need a war to go up. Gold needs uncertainty, and controlled North Korean provocation delivers unlimited uncertainty at a sustained low-level burn. Scenario 2. Escalation. North Korea conducts a nuclear test, or a missile lands inside Japanese territory instead of just outside it. This forces an American response at exactly the moment when America is most resource-constrained. In this scenario, the United States faces active simultaneous crises in two theaters. Defense spending projections for the year get revised upward dramatically. The bond market reacts. The dollar faces pressure from the combined cost of projecting military power across both hemispheres, and the institutional money that has been cautiously watching suddenly accelerates into hard assets. This scenario takes gold to levels most analysts are not currently projecting. Scenario 3. Miscalculation. This is the scenario that keeps strategic planners awake at night, and it is the least likely. But in a world where tensions are at maximum across the Middle East and East Asia simultaneously, the margin for error is razor thin. A North Korean missile malfunctions. It lands in Japanese territory. Japan responds. The U.S. is pulled into a second active conflict. A chain reaction begins. In that scenario, the entire framework of global financial markets gets repriced overnight. Not gradually, overnight. The assets that survive that repricing are the ones that exist outside the financial system. Physical gold, physical silver, assets with no counterparty risk, assets that do not depend on exchanges functioning, assets that do not depend on governments honoring their obligations. Even if Scenario 3 never materializes, the probability of Scenario 3 being non-zero is itself worth a risk premium, and that risk premium is priced in gold. The COMEX silver market. This is where the panic is showing up in the numbers. Now I want to show you something happening inside the COMEX silver market that is, in my professional opinion, the most alarming data signal I have tracked in the entirety of 2026. And I want you to understand the mechanics before I give you the numbers, because the numbers only make sense if you understand what they mean. In a functioning futures market, contracts roll forward. That is the natural direction of time. Traders who do not want physical delivery of their position move their contracts from the expiring month into a future month. March rolls to May. May rolls to July. That is the standard operating rhythm of a futures exchange. It represents confidence that the metal will be available for delivery when eventually needed. What happened this week is the opposite of that. May silver contracts, instead of rolling forward into July as you would expect, rolled backward into March and April. Let me give you the exact numbers. The May silver contract lost 579 contracts of open interest in a single trading session. At the same time, March open interest increased. April open interest surged by 486 contracts in a single day. 486 contracts flooding into April is not routine positioning. That is institutional traders deliberately moving their delivery date closer, moving from a month that is comfortably in the future, May, to months that are right at the doorstep. And here is the detail that makes this even more significant. April is not a major delivery month for COMEX silver. The major months are March, May, July, September, December. April is a minor month. The fact that 486 contracts rushed into a minor delivery month tells you these longs are not following the standard delivery calendar. They are saying, I do not care about the calendar. I want to be positioned for delivery as early as physically possible. I want my metal before something happens in May that prevents me from getting it. Add the 364 March delivery notices issued on the same day, and the near-term months absorbed a combined net increase of 864 contracts in a single session, while the May contract bled 579. The entire reduction in May open interest moved backward, not forward, backward. Why longs are panicking? The CME trust problem. To understand why this backward rolling is happening, you need to understand what the CME Group has done to the confidence of institutional silver traders over the past 5 months. In November 2025, the CME halted metals trading right before a major delivery deadline. The official explanation was a cooling system failure at their data center. Silver was in the process of hitting all-time highs at the moment of the halt. When trading resumed, the momentum was completely eliminated. The rally was over. In February 2026, the CME halted trading again. The timing, right before the March 1st first notice day. Silver was breaking above $91 per ounce at the moment of the halt. During the halt, while retail traders were completely locked out, 159 million ounces of notional volume moved through the system. When trading resumed, silver crashed $6. March open interest was cut by more than 50%. 2 halts, both at critical delivery moments, both when silver was at or near breakout levels, both resulting in dramatic price reversals that reduced physical delivery demand. That is not coincidence. That is a pattern. And institutional longs, the players with hundreds of millions of dollars in these positions, have recognized the pattern and drawn the only logical conclusion available to them. The exchange will halt trading at the worst possible moment for longs and the best possible moment for those who need to prevent delivery. The only way to guarantee receiving my metal is to position for delivery right now, not in May when the exchange has 2 full months to engineer another halt. That is what the backward rolling data is communicating. Not a technical adjustment, not routine repositioning, a loss of faith in the COMEX delivery system itself. And when sophisticated institutional participants lose faith in the reliability of a futures exchange, when the longs decide the only safe contract is the soonest possible contract, that exchange is facing a structural crisis that cannot be solved with a press release. The physical supply numbers, the math does not work. Let me now give you the supply picture so you understand the physical context behind this delivery panic. COMEX registered silver, the metal that is actually available and authorized for delivery against futures contracts, stands at 78 million ounces, down from over 100 million ounces just weeks ago, a 22% decline in available registered inventory in a matter of weeks. The Shanghai Futures Exchange holds approximately 9 million ounces. Shanghai is already pricing silver at a premium of $15 or more above Western prices, a spread that reflects genuine physical scarcity in Asian markets. London silver liquidity remains constrained following the liquidity crisis that emerged in late 2025. Now here's the number that should concern every person watching this video. May open interest on COMEX currently represents 77,895 contracts. Each contract is 5,000 ounces. That is 389 million ounces of silver represented in May open interest alone, against 78 million ounces of registered deliverable metal. A 5-to-1 ratio. 5 times more paper silver promised for delivery than physical silver available to deliver. And now some of those May longs are deciding they do not want to wait until May to find out whether the metal will actually be there. They are moving earlier. They are moving now. If that backward rolling accelerates, if the 579 contracts we saw this week becomes 1,000, becomes 2,000, becomes a sustained wave of longs demanding early delivery, the pressure on the near-term months becomes mathematically extreme. An extreme delivery demand in a market with 5-to-1 paper-to-physical ratios does not resolve gradually. It resolves in a price dislocation that the market structure is not designed to absorb. The dollar ceiling and what happens next. The dollar index surged to 100 on safe haven demand generated by the Iran war. This temporarily suppressed gold and silver prices this week, which is standard behavior. Dollar up, metals down, short term. But 100 on the dollar index is historically a ceiling, not a floor. Every time the dollar has reached this level in recent cycles, it has been the exhaustion point, the level at which the currency's strength begins to reflect its own contradictions rather than genuine demand. What happens to the dollar when the market begins pricing in a second military front? What happens when Congressional Budget Office projections start incorporating $7 billion per week in combined defense spending across 2 theaters? What happens when the Federal Reserve, meeting on Tuesday, March 18th, has to acknowledge that war inflation is making rate cuts dangerous while economic stress from the war is making rate hikes equally dangerous? The Fed is trapped. Cut rates. War inflation accelerates. Raise rates. The war-stressed economy breaks. Hold rates and watch inflation expectations drift higher as the war continues with no end in sight. Every path the Fed takes from this point leads to the same destination for precious metals, higher. Not because gold and silver are trendy, not because of speculation. Because when the currency issuer has no good options, when the tools that worked in 2008 are not available in 2026, the market migrates toward the assets that exist outside the system entirely. Gold does not need the Federal Reserve to function. Silver does not need the CME to hold its value. Physical metal in your possession does not depend on exchange integrity, government solvency, military success, or dollar strength. In a world where all four of those pillars are simultaneously under pressure, that independence is not a feature. It is the entire argument. The connection nobody is making. Here is what I find most revealing about everything I have shown you today. The North Korea missile launches and the COMEX backward rolling happened on the same day. The geopolitical analysts covered North Korea. The precious metals analysts covered the rolling contracts. And essentially, nobody connected the two stories into a single coherent picture. But when you connect them, when you place the military overstretch beside the delivery panic, beside the dollar ceiling, beside the bond market stress, a single clear picture emerges. The people with the most information and the most money at risk are positioning for a world that is becoming structurally different from the world of the last decade. They are not waiting for confirmation. They are acting on probability. The institutional longs rolling backward on COMEX are not doing it because they read a news headline. They are doing it because their risk models are telling them that the probability of a delivery failure in May, given exchange behavior history, given physical supply levels, given geopolitical trajectory, is high enough that waiting until May is not an acceptable risk. They are acting on information, and their actions are visible in the data if you know where to look. In 2008, the financial crisis was fundamentally a crisis of leverage and bad debt, complex but single-dimensional. The Fed could address it with one tool, liquidity. In 2026, the simultaneous pressure points are financial, military, geopolitical, monetary, and physical supply, all compressing at once. There is no single tool that addresses all five. Print money, war inflation gets worse. Cut rates, energy price inflation accelerates. Raise rates, war-damaged economy fractures. Halt the exchange. Institutional confidence evaporates permanently. Ignore North Korea. The two-front scenario becomes reality. The toolkit that saved the system in 2008 is structurally unavailable in 2026. And the problems are larger, more distributed, and more interconnected than anything we faced 16 years ago. What I am watching next week. 3 catalysts, 3 potential market-moving events, all converging in the same 7-day window. 1. The rolling backward data. Watch whether the 579 contracts from Wednesday is the beginning of an accelerating wave or a single-day event. If we see continued backward rolling in Thursday and Friday data, the near-term delivery pressure is building toward a critical threshold. 2. The Federal Reserve meeting on Tuesday, March 18th. This is the single largest macro catalyst of the month. If the Fed acknowledges war-driven economic deterioration, the dollar weakens and metals break higher with significant momentum. If the Fed stays hawkish and dismisses the war's economic impact, metals stay under pressure short-term. But the underlying physical supply situation does not change. The squeeze gets deferred, not canceled. 3. North Korea. Any additional missile launch, any nuclear test signal, any further escalation of the East Asian provocation campaign builds the two-front narrative that the precious metals market has not yet fully priced. The insurance premium on global instability has room to expand significantly if Kim Jong-un decides this week that the window of American overstretch is closing. Any one of these 3 catalysts has the potential to move gold and silver 5 to 10% in either direction in a single session. All 3 converging in the same week is the kind of confluence that produces market moves that people write about years later. I will be covering every data point as it develops, every OI update, every Fed statement, every North Korea development. Drop a comment right now. Tell me, do you think North Korea escalates further this week? Do you think the Fed acknowledges the war's economic damage on Tuesday? And do you think the backward rolling accelerates or stabilizes? I will pin the most insightful analysis in the comments. If you are new to this channel, welcome. I cover COMEX delivery mechanics, the real physical silver and gold supply picture, geopolitical impact on precious metals markets, and the data signals that tell you what is actually happening underneath the surface of these markets before it shows up in the headlines. Hit subscribe, turn on notifications, because next week is going to move fast. Share this video. The The backward rolling story and the North Korea connection are not being told anywhere else in the precious metals community right now. Help me reach the people who need to see it. This is Market Decoded. Follow the data, ignore the noise. And remember, physical metal in your hands has zero dependency on any of this functioning correctly. See you Tuesday after the Fed.